Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and that scary wall of worry. So today I want to talk about volatility. Market volatility has certainly arrived in force the last few weeks. And as investors focused on retirement or other financial goals, we understand that market volatility can feel unsettling. But it's good to remember that it's a normal and necessary part of investing. The key is to stay disciplined, to keep your long-term goals in mind and make informed decisions without letting emotions take over. If you're feeling uneasy about your portfolio, the best step is to check in with us to ensure that your plan is well positioned to weather these fluctuations. So let's talk about what's happening in the markets. Lately, we've seen more volatility than usual, which might feel jarring because markets have been on a relatively smooth path over the last 2 years. The S&P 500 now has been down 5 of the last 6 weeks, which is not unusual in the whole grand scheme of things, but it's certainly a change from the stability that investors have grown used to the last 2 years. And while this level of volatility is not extreme by historical standards, it stands out against the backdrop of the recent calm that we've seen. And naturally, this leads to more questions and concerns. So let's break things down. First of all, what's driving the volatility that we've seen? Well, one major factor is uncertainty surrounding U.S. trade policy. The Trump administration's tariff policies have created some unease. Are they simply negotiation tactics, or do they represent a more permanent shift? The answer is it's likely a mix of both. I think that the bigger question is whether these policies will cause inflation or significantly weaken the economy. And while it's too early to say for sure, we've already seen slight signs of economic softening, particularly in consumer spending and in job growth. And even though both remain on solid footing, the slowing pace of growth is what often catches the market's attention. On top of trade concerns, political tensions have also added to market anxiety. The increasing polarized political environment has raised questions about the government's ability to pass a short-term funding bill before the March 14th deadline, which, as I record this video, will be tomorrow. If an agreement is not reached, then parts of the government could shut down. And while political debates are certainly not something that's new, this type of uncertainty tends to make the markets a bit nervous for good reason. Another issue at play is that the markets may have been priced coming into 2025 for perfection. Stocks surged after Trump's election win, and investors seem to expect nothing but good news ahead. And when markets get ahead of themselves, it's common to see a pullback. Investors position for an event, then they take profits once it happens. That might be what we're seeing now as momentum has slowed a bit. That's why we've been cautioning investors in recent months to be a little more measured in their approach. So the question is, what should investors do? Well, despite the recent turbulence, the fundamentals of the economy still remain strong. While this market pullback may feel uncomfortable, it's likely just short-term noise. That being said, we've been warning this year could be a bit bumpier than the last two, and recent weeks serve as a reminder that markets can move very quickly. Our piece of advice to begin with is don't panic. Volatility is normal. It's like, I guess you could say it's like a toll that investors must pay on the road to attractive long-term returns. The stock market corrects once per year on average, and a correction being defined as a drop of 10 to 19%, and has still achieved a 13% annualized return going back to 1980. Here's maybe another way to think about the value of staying invested. If you were to miss the best day of the year, and that usually comes during volatile market environments when stocks are in a correction mode, your annualized return takes nearly a 4% hit. That's a drop from 13% down to an average of 9%. And if you were to miss the best 2 days of the year, that hit would be nearly 7%, bringing your return from 13% down to 6%. Uh, a recent Dalbar study revealed that investors generate returns about 5% below the overall industry. Why? Because of excessive trading. Trims and ads with guardrails make sense for active investors, but going all in or going all out is a recipe for falling short of your long-term investment goals. What I'm trying to say is that market timing can be extremely costly. So instead of trying to time the market or trying to outmaneuver trading algorithms, the best approach, in our opinion, is to ensure your portfolio is prepared for both the ups and the downs. This period of volatility, in our view, is likely to be relatively mild compared to past downturns. As always, staying focused on your long-term goal is the best course of action. If you have concerns, though, please don't hesitate to reach out to us at our office. As always, we look forward to seeing you soon. Thank you very much.